And joining us now to share his commentary on the day's markets performance is Sam Houlie from Differential Capital. Sam, thanks so much for your time this afternoon. And let's perhaps start off with your assessment of local markets action. Now, we heard news from the Trump administration yesterday hitting SA with tariffs worth 30%. On Sunday, he said, the BRICS-aligned nations could face an additional 10% tariff. I don't know, I would have expected to see a bloodbath on markets, but markets seem to somewhat be shrugging it off. What's going on?
Yes, thank you. I think what's happened is markets are discounting mechanisms, and we've learned, if you go back to early April, the famous Liberation Day, where this was the first time where the Trump administration started this tariff. It's almost like it's a dance, between the US and all the other countries.
Tango.
Yes, in a sense that they make an announcement. It's quite a provocative announcement. And the markets have since learned that if you respond immediately, then there are different iterations and there are negotiations that have to take place. So, if you look back, from early April to the end of June and the end of the quarter, the markets recovered in a V-shape. And now we're in the early start of this quarter and we're back. We're back to this dance. And the market, I think, has just shrugged it off because there's a lot of water that still has to flow under the bridge. And I think that what will happen now is everybody, the way the Trump administration appears to be working, make a provocative announcement and then enter into some prolonged negotiation that results in some sort of resolution further down the line. So and the market's waiting for that. Yeah.
So basically taco trade at this point.
Yes, that's exactly it. It's exactly it. There will be some sort of negotiation, which includes an adjustment, a compromise, a capitulation. At some point from some party, and yes, that seems to be the new way. 5 months ago we didn't know that this would be the case, but here we are.
And just generally, when it comes to the statements out of the Trump administration, are you concerned? Are you worried about, the shift in dates, right? We know that July 9th deadline is around the corner, basically tomorrow, but we now have this August 1st date that just comes out of nowhere. Are we now shifting towards that date and perhaps tomorrow doesn't matter as much?
Yes. I think, the discounting mechanism in the market has now worked out that every date is just an opening salvo or a next version, and the only thing that really matters is the final version of the signed event.
All right.
And so we have August 1st. July 9th will come and go, and I'm not sure if August 1st is even cast in stone. So I think that to step back, the market is realizing that this is not a sideshow. It's very important, but it's happening in the background, and you still have to focus on the underlying fundamental data. So if you look at commodity prices have continued to trade based on supply and demand fundamentals, and which is why you'd see commodity-related stocks who do well, irrespective of what's really happening, because they are now driven by the most important driver for commodities, and less by what's happening in the trade world.
Yeah. And talking about commodities and perhaps shifting into, that safe haven realm, we also know that the dollar has that safe haven appeal, but it's been interesting to see how the dollar has been performing over the past 6 months. It's shed over 10% in the first 6 months of the year, marking the worst first half in over 50 years. Yes, this is benefiting the rand and benefiting us. But what is going on? I mean, you'd expect that, with all these tariffs and, of course, its safe haven appeal, that it would be shooting the lights out.
Yes, it's nuanced. There are a lot of different factors. So the answer is not a straightforward one. The first point is that the uncertainty around tariffs and trade and just multiple deficits. The US doesn't just have a trade deficit that they have to at various points. They have a budget deficit themselves. They were trying to put a bill through Congress. Then there is the level of interest rates itself, which ultimately impact on whether there's a demand for dollars and foreign currency markets. So I think that all of those have come to bear in the case of the dollar, which has meant that there have been net dollar sellers as opposed to dollar buying. And the reserves currency status remains, but the demand for the dollar has actually waned at the margin, and that's what you've seen. So
Yeah.
yes, that's.
All right, let's move over to some company news, Sam. Shein has really been struggling when it comes to listing, from attempts to listing in the US to London, and reports now suggesting that it's looking at an IPO in Hong Kong. Perhaps just your reading on the potential move. Is the third time a charm for Shein?
It's not looking good. My view on Shein, so let's step back. Why would you want to do an IPO, an initial public offering? Is because you're trying to raise liquidity and capital for the original shareholders. So the founders of Shein is a Chinese founder, and the private equity backers, including Sequoia Capital in China, they are looking for some sort of liquidity event to exit their position, hence the IPO.
Yeah.
And if you have an IPO, you need three things. You need certainty, relative certainty. You need good growth prospects. And you almost need to have a line of sight of what's going to happen in the next 2 to 3 years. Well, actually, the problem with Shein is precisely what's happened with tariffs and the uncertainty is that none of those things are certain. All of a sudden, it's very murky, it's very difficult. And I would argue that it'd be very difficult for them to get this away.
All right.
And even if they do, the price is going to be very low.
Yeah.
So for the owners of Shein, it's not the best news,
Is
unfortunately.
it worth it? Is it even worth it if the IPO price is low? All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what other industry players find interesting.
It's NXP Semiconductors, which is a Dutch company, which is the first positive because it's not, in America. They have a niche advantage in semiconductors in that they don't really compete with the likes of NVIDIA and the really advanced microchips because theirs is used first of all in the car sector and where they use their chips in things like radar and LiDAR, which again doesn't compete with those high-edge NVIDIA kind of chips, which is in the fully, which is for the driving part of things. And then secondly, they've got an industrial component where again their chips are specifically used in factories where there's where there's huge where they've got to be very robust as far as temperature is concerned, the working environment is concerned. So they're not necessarily high end, but they are built to last, where they, as I said, have a niche. And with that whole sector being quite positive at the moment, I think that's the added benefit you get from them because they have those specific modes in place.
My stock pick is Astral. They are a chicken producer. The South African chicken market is called 20 million chickens a week. They produce about 5 million chickens a week. One of their large competitors, Daybreak, is essentially gone out of business. Feed prices, which is 60% of the cost of a chicken, are well under control. The selling price of what we call IQF, individual quick frozen chicken, is up 20% over the last 12 months. And this business is on about an 8 or a 9 PE. It's a simple business with exceptionally good management and I think strategically well placed at the moment.
So Sam, Shane going with a local player, Astral Foods, and Rick is going across the shores over in Europe with NXP Semiconductors. Just your analysis on those stocks.
Firstly, on the global semiconductor industry, we're not invested in it, certainly not, and I can't really comment. I would just add that you've just seen that Samsung Electronics has just come out with a profit warning, and that market itself is very fluid. You know, NVIDIA is onshoring. The Trump administration wants to bring everything to the US. So everything that was happening in the last 2 to 3 years, you should actually really almost, reset. So I'd be very careful there. And then in terms of Astral, we agree broadly with the hypothesis. For our clients at Differential, we invested in Astral as well, so we agree. We would add 2 more things on Astral, which we think listeners would be happy to know. We think margins could actually expand even more because firstly, the costs at Astral are much better. That if you think in terms of the mortality rates for chickens, they're lasting longer, they're living longer. Therefore, they're more efficient. So literally, with costs coming down, you then have to look at the price. And the price, in fact, winter pricing has been a lot better than it's been in the past, which tells you that pricing's good. So margins are going to expand. Prices higher, costs lower. So we think that Astral, in fact, is a very good idea.
All right, so you like Astral, but that's not your stock pick. Where are you hanging
It's
your
not.
hats? Where are you hanging your hats this afternoon?
It's interesting. So I just need to say two things before I go into the idea. The first thing is you asked us for stock picks on the show.
Yes.
And the stock pick is never in isolation. You have to say, what is a good stock pick today in the context of the market? Now, the market is very high now,
Yes.
which means that you can't just think of upside, how much money you make. You have to think of the downside, how much money you can lose. So the idea that we have is Renette. And the reason we like it is the risk reward profile, which is the reward, the return you can make relative to the risk you take is very attractive. The other thing is that we look at data at Differential, and we try to work out how much of the data is known versus what's unknown. And there are a few things that we know about Renette. The founding family is the Rupert family, common to Richemont and Remgro. They've just made an announcement where they've sold their biggest asset, Pension Corp, in the in the UK. So literally based on that, the current share price of Renette in euros is around 4.7 billion. And in 9 months' time, you know with certainty now that you probably have about 5.7 billion euros in cash. So you'll have cash in 9 months of 5.7 versus a share price today of 4.7 and an NAV of close over 7 billion euros. So there's a massive discount to the cash you'll have in 9 months and a massive discount relative to the NAV. And then the family and the owners, the management of Renette, are now 100% aligned with us, the shareholders. We both aligned to try and create share value. So if you think of the risk-reward profile of that, in the context of a market that could actually go sideways, we think this is a very, very good idea. Because, it's cash, it's safe, it's solid, management's aligned, but there's a lot of upside ranging between 15 to 20% plus. And it will all play itself out in the next 9 months. You don't have to wait 5 years. It's only 9 months. So for that reason, it is a very good idea in the context of today's market.
All right, let's leave it there. Sam, thanks so much for your time and joining us this afternoon. Now, that was Sam Houlie from Differential Capital.